All right, so can everybody see my screen? Oh, good. Okay. All right. So let's start. So the first few questions are multiple choice questions, and let's take a look. So the first one says something about the bid-ask spread in the limit order book. Right. So we mentioned that the limit order book is a book that captures the standing orders. All right. So let's look at the first one. Represents the total number of shares available for buying and selling. So that's actually partially correct. So we have shells, but for each different price level, right? It's not really total number because we have different tiers, price tiers, which are standing orders that are yet to be fulfilled. All right. So the second one says indicates the highest price what the buyer is going to pay and the lowest price for the selling side, which also partially correct. So there are different price tiers, and if you look at the sell side, right? So I have different tiers, and then we have buy side, different tiers as well. And then this gap is what we call the bid-ask spread, right? So this is spread. Option C says it signifies the profit broker can make on the difference between the selling and buying price. So this is the margin. This is the spread, right? But the not necessarily the profit for the broker because that's essentially representing the indication of market liquidity, but then not necessarily the profit for the broker. Um, so option D says it is a price difference between the best bid and best offer. All right, so this is the best bid, and this is the best offer for given financial instrument in the LOB, right? Which is correct, because we just need to identify these two price levels, and then we can identify the price difference, which is the spread, right? Which is bid-ask spread. So the first one is relatively intuitive in terms of the understanding of their limit order book. All right. So that's for the first one. And let's come to the second one. So the second one says, is the stop order subject to slippage? Okay, so we encounter this question, we should immediately map these keywords to their conceptual understanding. So first, what is a stop order? Right, so we mentioned that this is actually a type of market order that's accompanied by a trigger point, right? So there's some trigger, and for example, we have, for example, a price line, right? So if the market price drops below this trigger point, then this order triggers, right? So this stop order can be understood as a safety mechanism to automatically protect us from further loss, right? So for example, if this is the market price of a stock, and then we set a trigger price at this level, and if the price drops below this level, right, we can immediately say, let's sell this stock to prevent us from further loss. So that's a safety mechanism. And in this case, right, it helps us stop the loss. So it's a stop order, and it is actually a market order. So when it is a market order, it sort of guarantees the execution, but not necessarily the price, right? So that's the biggest difference compared with limit order, right? So it's market order, then that means at this moment onwards, right? So it's gonna become a market order. So this stop order gonna become a market order, and then look for the best price that can be satisfied, right? So the moment we transact, for example, this is another price, right? So the actual execution price may not necessarily be the same as the trigger price, right? So these two, these two price points are not necessarily the same. So if they are different, and most of the time they are, right? So we call this slippage because the ideal execution price is different from the actual execution price, And that's because of the nature of market order, which is that the price is not necessarily guaranteed, right? So especially for those assets who are not so liquid, right? So and also for those who are highly volatile. So every moment the price may change, and the final transaction price may be probably different from the price we would like to be, right? So the answer is yes. We need to. It is subject to slippage. Okay. So that's the second one. So any question, feel free to speak up or just type in the chat box. I'll be looking at that as well. So let's look at the third question, and it is about the order type, which is market if touch order, so or MIT order. And we're asked the difference between MIT order and the limit order, right? So this is another type of order that belongs to the market order. So this is still a market order, right? So still a market order. That means it's going to be subject to slippage, right? But limit order is another type of order that's not subject to slippage. In fact, it is just to limit the price, the transaction price, right? So if it's not the price that I want, or even a better price that I want, right? Then I'm not going to transact. So this one guarantees the price, but not the execution, because I may need to wait for a very long time to fulfill this order. Okay, so these two types of orders, so what's the difference? And again, back to the market if touch order. So this is typically a type of order, as we mentioned in the previous class, that's used to gain a preferable position, right? So for example, this is the market price, right? And then the market if touch order says if the price drops to some trigger point, then I'm going to enter into the position, right? So either buy or sell. So in this case, if this is my trigger point, right? So if say this is my trigger point, I'm going to enter into a buy position, right? So I'm going to buy this stock if the price drops to a particular trigger point. So that's one use case. Or you can say that's if the price rises, right, rises to some level, and I'm going to sell it, right? So it's looking for the preferable scenario, and if this scenario happens, then we're going to enter into the corresponding position. So I want to buy low and sell high, right? So that's what market touch order represents. Okay, so let's look at the the options we have. The first one says MIT order is executed at a specific price, which itself is not necessarily true because that's what limit order does, right? So second option, so limit order is used to buy or sell securities at a specified price or better. That's correct, right? Specified price or better. And then MIT order becomes a market order when the market price touches the MIT price, which is correct. So when it touches the trigger point, then it becomes a market order. And if it is a market order, it guarantees the execution, right? And then but it cannot guarantee the price. So that's the second one you can choose, right? So I'm just going to skip the other ones. So let's move into the next one. Okay, so this one, right? So we're asked something about the exponential moving average EMA. Okay, so when you encounter this one, and immediately you should think about what it means, right? So we're going to calculate a smoothed price, right? So EMA for time period t, right? So at this point, I want to calculate the corresponding EMA. So what do I do, right? So it is going to be a combination of the current disk price, which is ST, right? So this is the price for current period, and the previous period EMA, right? So t minus 1. Okay, so it's a combination of these two. And how are we going to combine it? We're going to use something called alpha. So it's a weighting parameter. So it's alpha times, or you can say this is A. So I'm just going to use alpha. There's alpha times ST plus 1 minus alpha. So this alpha is a number valued between 0 and 1, right? So that value between 1, and therefore it's just a weighted sum of these two price points. Okay, so if that's the case, let's plug in the numbers. So stock price is $50. That means ST is equal to 50. Okay, so for the particular day, and EMA from the previous day, which is our EMA T minus 1, right? This one is 42. 48, right? So these are two numbers we have, and we also given the alpha, which is set to 0.1. Right, so with these three numbers, then we can just safely plug in and calculate the EMA. Okay, so that's essentially testing our understanding of the equation here. But of course, there's no need to memorize this one. That you can put it in the final exam cheat sheets of your design. Then, but what's more important is how to be able to know how to use this formula to get the corresponding smooth price, and that applies for the simple moving average as well. Okay, so that's for the fourth question. So let's look at the fifth question. So investor is looking to execute trades in the volatile markets where a particular stock is less frequently traded. So that means this stock itself, this asset itself has a low liquidity, right? So the current order book shows a wide bid-ask spread, which makes sense because if it's not so frequently traded, then there's not so much supply and demand, and then therefore the gap will be bigger than those liquid assets. Okay. So this is the picture of the order book, right? So we have the buy side and we have the sell side. Okay, so bid-ask. So for the buy side, we have 50 shares at $100. So typically they come in pairs, right? So we have the volume and we have the price, right? The volume and we have the price. This is going to be at different price level. So we report this as this one is the most the best bid, right? So we start with the best bid, then the second best bid, etc. Okay. So for the ask sides, we have the best ask, right? Best selling the best offer. So 50 shares as 105, etc. Right. So then the price goes up. Okay. So that's the current snapshot of the limit order book. So the question says, the investor places a limit order to buy 200 shares with a price limit of 106 per share. Okay. So that means if the investor wants to buy something, right? He wants to buy something, then it means that it's going to look at the ask side because that's the offer side, right? So that's to buy the assets from those who are offering to sell. Okay. So and then this is a limit price, right? So when we say this price limit, it means that I'm just going to transact at a price less than or equal to this limit. Okay, so this is a limit order. So it satisfies that its transact does not, then do not transact. Okay, so given the immediate post-order book status, then calculate the number of shares bought. Okay, and then the average price paid per share, and then the remaining number of shares left in the limit order. Of course, such transactions may bring some market impact. So the assumption is that we do not incur any impact, right? So it's just for this execution. Okay, so let's take a look. What we want is 200 shares, right? Want to buy them, but there's a condition. So this condition is a condition that's that limits the price to 106. So let's look at the offers. We have 105, 107. So only 105 satisfies. Right? So that means I'm just going to get to look at this portion because the rest I can ignore. Right? They are outside my limit. So we have 50 shares. Right? So out of 200 shares, we can satisfy 50 of them. Right? So can satisfy 50 of them. So let me move this down a bit. So we can satisfy 50 of them. That means that number of shares bought is 50, right? And the average price per share. So we bought 50, right? We bought 50, and then each price is 105. So therefore, the price is also 105. Okay, because the rest 150 is not fulfilled, and then that's gonna make the remaining number to 150. Okay, so that's so we can choose corresponding option here, which is option D. Okay, so that's how we can analyze the limit order book, understand its structure, and then do the calculation correspondingly. All right, so moving on. Okay, so this is another multiple choice. Let's look at this scenario. So it's also asking something about a highly volatile stock. Okay, so when you see this keyword highly volatile stock, it means there's a high there's a higher volatility for the stock, right? So it's the price change a lot. So currently change trades at 150 per share. And so we have the investor is considering placing a buy limit order because they want to purchase stock at a price no higher than their specified limit. So that's the definition of buy limit order, right? So I only buy when the price makes sense for me. Okay, so they want him to capitalize on the price dips when avoiding buying during temporary spikes, and that's essentially same thing. Okay, so I want to avoid the temporary spikes in case it is very adverse for me. So the question is, what is the correct statement about execution of buy limit order? And this is just again asking the definition of the buy limit order. So let's look at the first one. The buy limit order will be executed immediately, which itself seems to be wrong, right? So hold on. So let's for the okay, so right. So that's actually the feature for market order, right? But the moment you counter this immediately, that's the keywords you want to be careful. And we're dealing with the limit order, so itself makes this statement wrong. Okay, so it's not gonna be executed immediately. Most likely, right? So second one says the buy limit order guarantees execution at a specified price, which is not necessarily true, right? The buy limit order will be executed only if the price itself reaches or falls below the limit price, right? Less than or equal to. Then it will be transacted because that's the condition we set for the limit order. So it does not guarantee execution, right? The order may not necessarily be filled. So that matches the definition of a buy limit order. Okay, and similarly, if it's sell limit order, right, and then the condition will be or more than or equal to. Okay, so because I want to sell at a good price, or even better. Okay, so that's the condition for the limit orders. All right. So any question, feel free to ask. I'm just going to quickly analyze and then provide guided answers for the rest of questions. Okay, so let's look at this one. So this question says, investor is considering portfolio consist of two assets. So I have two asset case, S and T, right? So asset S has an expected annual return 8%. So for so when we encounter this calculation questions, it's actually good to immediately write some notations. So here we have mu S equals to 8%. And then you should know what mu means, right? Mu means the expected annual return. And we mentioned that this is the input, right? We need to do portfolio optimization, right? So this is actually capturing the gist of asset A, right? So we have one element. Of course, we have another element, which is sigma S, right? Which sigma standard deviation is 12%. So this is another element. So we know these two guys, then we can run different calculations or even run optimization. So SIT, so we have 8, we have 12. SIT, we have 14%, right? 14%, and the standard deviation is 18%. Okay, so that's the ingredients we have. And I was also told the correlation coefficient, which is rho ST, right, is 0.6. All right, so that's the correlation. But I know you should know the definition of correlation, which is essentially the a scaled version of the covariance between SNA and SIB, right? So this covariance between SNA and SIB, right? So SAS and SIT, we have that covariance, and we're going to standardize it by the individual standard deviations, right? So that's actually a definition of correlation, and this is our covariance. Okay, this is our covariance. So I given the weights as well. So I'm going to allocate 6% to SLS. That means our WS is 0.6, and that makes the WT 0.4. Okay. So these are our ingredients given. So we're asked the question. So first one is portfolio, expected annual return, and portfolio variance. So again, so we record the definition of portfolio level, return, and risk, right? So the portfolio return, RP, so R is for return, is defined as a weighted sum. So we weight by W, and W here is a vector, right? And then by the individual the vector of individual returns, right? So there's a vector, and it's just going to hold on. So this should be mu. Let me erase it. It's not a random variable. So here it should be expectation. So this mu essentially is a vector that contains these two guys, right? So I'm just going to do this to lay out the calculation here. So we have WS and WT, right? So this is a vector, it's a row vector, times it's a dot product, times the column vector, which is mu 8%. It's just going to write the rotation here, 8% and the mu t. Okay, so that gives us the portfolio level return. Okay, so you can multiply, and this is 1 by 2, and this is 2 by 1. So the final result will be 1 by 1. Okay, so that calculation makes sense. So now comes the portfolio variance, which is essentially the variance that's a weighted version of the two assets, right? So for these two assets, we need to consider their individual variance, right, as well as the correlation or covariance. Okay, so these three things are something we need to factor into. So record the definition of portfolio variance because of the weight is W. So the definition is like this. So this is a vector, right? Transpose, then the sigma, so which is our covariance matrix, and also W as well, right? So this is the definition of our portfolio variance. And of course, if you write in bring in their in the vector form, then we have WS, WT. So this is the row vector along with the covariance matrix, right? So we have sigma S, right? So this is square, and then sigma ST, sigma TS, and sigma T square. Okay, so this is their individual variance, and this is their covariance, which is equal to each other, right? Because this just switching the place. All right, so this is what we call covariance matrix. Okay, the covariance matrix, and then finally we have their column vector WS and WT. Right. So if you do the calculation, if you multiply these two guys first, it's just basic linear algebra, right? Then multiply here, you will get something 1 by 1, right? Because it's 1 by 2, this is 2 by 2, and this is 2 by 1. So you can cancel. So final result is just one number, right? So just leave it to you to do the calculation. And this example essentially gives us the chance to practice, to plug the numbers, do the calculation, and then get the final results, right? Of course, when we write it in the future courses, right? So when we write it, this is the most succinct form, right? This actually with this form, it's very easy to do mathematical analysis. But when you do calculation, it needs to be something like this in order to do the calculation. All right. So that's for this question. Okay, so moving on. So this question is asking something about the okay, so we have a series of price, right, so all the way to here. So it should have been less than this, just for illustration purpose, but then the numbers here just for to simulate some real the changes in the real data, right? But essentially it's a time series, right? Imagine it's a time series that's taking different values, different days, right? So we're asked to calculate the maximum drawdown. So this question tests the understanding of maximum drawdown. This is important because other than the profit, right? So we have some strategy, and we implement it, and then we get some profit. But this profit may look very good, right? So have good profit, a good Sharpe ratio. But then the drawdown is also something that's equally important, right? So if you have a good strategy that gives you 200% return, but your max drawdown is 50%, that's very risky, right? So even if it looks very good, but at some day, right, it's very likely to blow up. Okay, so this max drawdown essentially says what is the worst sort of drop, right? It's the biggest drop in my portfolio that I could have ever experienced, right? So to calculate this drawdown, we actually emphasize something about the prior peak. Okay, so you always compare yourself every day with the prior peak. So how to calculate prior peak, right? So let's look at this graphic illustration. So every day I have some number, and I'm just going to construct another curve that represents a prior peak, right? So this first day itself is the same. So let me just just going to use another color, right color. Okay, so first is itself. Second day is also itself because this is a new high, right? So my current second day is this one, the same point. Third day is still this point, right? Because it should be the previous peak. So essentially that means that this is the same, right? So every day I'm just going to look at previously until today, right? So what is the highest value? So this is prior peak, right? So in the NumPy, you can use the NP. I think it's a cumulative, right? Cumulative max, right? Something like this. So you can search for the function to calculate the prior peak. This day itself is this one, so that means we jump up to this number, and then this goes down, but so we maintain the prior peak. So it's going to be something like this. If we draw out the prior peak curve, okay. So once we drop the prior peak curve, then the rest is to calculate the drawdown first. So we need to calculate the drawdown before we calculate the max drawdown. So drawdown essentially is the daily drawdown if our data is daily, right? So this time every day we're going to calculate the percentage difference between these two guys, right? Percentage difference. So for example, for this day, we're going to calculate the current day price. So this current day price, right? And then we're going to minus the corresponding prior peak, right? So prior peak. So this day t, so the prior peak is also as day t, right? And then divided by prior peak at day t, right? So this just to make it as converted as a percentage loss. Okay, so it depends on how big is the fall, and then we're going to assess what is the biggest drop in the asset value, right? That's what we could have experienced. So this is the procedure in terms of how we calculate the drawdown, and following these 3 steps, right? So this prior peak step 1, and the percentage difference step 2, and step 3 is just to take the max, right? So in this case, it's gonna be this is gonna be a negative number, and then you're going to take the minimum, right, which converts to maximum. So you call the number maximum drawdown, but itself is actually a negative number. But when we report it as a positive number, right? So that's so the specific calculation details are a little bit to explore, right? So that's how we calculate. Okay, so let's move on. So the next question says something again about limit order book, right? So we have this simplified version, and we have bid and ask size, right? So we have the price as well. So this is the snapshot of the order book. So 100 shares for 50. As usual, the price will go down to 49.48. The ask size so this is the best ask, and then the price will go up. Okay. So the investor intends to execute transactions using a combination of markets and limit orders under the following conditions. So the investor places a market order to buy 250 shares, right? So if it's market order, that means it's going to guarantee the transaction, but not necessarily the price, right? So this 250. Now this is a buy order, right? If it's a buy, then you need to look at the sell side, the ask side. Okay, so we need 250, and we need to start with the best ask. Okay, so best ask says I have 100. So if it's 100, then it's going to get fulfilled. So all this price tier, the volume gets fulfilled to the initial 100 shells. Right? It's gonna be 100 shells transacted first plus the remaining 150. Okay, so where does this 150 go? It's gonna be the second tier, right? Second tier happens to be 150 transacted at 52. Okay, so that's the process of fulfilling this order. So the second point is after the market order is fulfilled, is fully executed, the investor places a limit order to sell 300 shares at price 52. Okay, then what happens is that this is so because so we have these two gets fulfilled, right? So that means this is gone from the market order from the limit order book, and now we place a new 300. It's going to be 300 shares valued at 52. Okay, so what this means is that I'm providing a new liquidity to the market by offering the best price, right? So because the remaining will be 53, which is higher than what I offer, right? So basically, I place this order and then I offer something best in the market, right? So that's the process. So let's look at this question. All right. So the first question asks the total cost. The total cost will be the shares we bought at first tier times the unit price plus these shares times the unit price, right? So it's gonna be a weighted sum. Right, so that's the first one. The potential revenue from sell order. So this sell order says, so the question says that's so if the limit order, is fully executed, right? So that means if I fully manage to sell these 300 shares at this price. So what is the revenue, right? So it's just these two numbers multiplied together. So final one is net position. If the limit order is fully executed, right? So it's gonna be the difference of these two, right? So difference is two. So first going to buy, that means going to the profits. The P&L is negative, and then this is positive, and just take difference of these two. Okay. So that's analysis for this question. All right. So okay. So any question, feel free to ask. So let's come into the last question, and this question tests us the understanding of moving averages, right? So in this case, it's a simple moving average. So there's some trick in this question, right? Let's take a look. So this text just describing the process of a crossover strategy. Right. So the context of the question is we have the last 20 days of data being collected, but we may not necessarily be given each and every day's price. Right? So what we're giving is on day 250, the SMA, right, simple moving average for 50 day. The short move average is 20, and also the long move average, which is 200, is 90.5. Right. And on day 251, okay, so the closing price is 21, and then so that's the new closing price. We're also given the closing price 200 days ago, right, which is 180. Okay, so you need to think about why are we given only the initial price and the next day's price, right? But we're not given the full price history. So there's an assumption, and what asks is to calculate the new short-term and long-term moving average for this new day, indicate whether we should buy or sell. Okay, so let's denote this as t, right? So original, okay, so maybe this denotes as t. Okay, so lowercase t, and this is t plus 1, right? So let's record the definition of SMA at day t. Right. Um, so it's essentially going to be moving average, right? So there's two parts. First, it is average, right? So that means we need to first add something, right? And then divide it by something else, right? Divide by something else. So this, let's denote this. So let's denote this window size as n, right? So we have n periods in this window. So this divided by n. So summation wise, we'll just sum from n periods from the past, right? So let's for example say that this is period t. So this is st is our last period plus st minus 1, right? It's previous day, and all the way to st minus n, right? So this is n periods. But technically this should be t minus n plus 1, but then we're just ignoring the counting here. So just make it intuitive. All right. So so this is just to say that we have n number of price points. We're just taking the average. Okay. Now we move into SMA t plus 1. Right. That's what we want to calculate. So the new short term, which is SMA t plus 1. Right. So that's gonna be st minus 1 plus st plus hold on, so this let me write again. So what we need is still we have n periods, right? So there's still n periods because it's the same window, but we have the new price point comes in to the window. Okay, so the new price point would be st plus 1. All right, so that's the new period. We still plus the previous periods, but now this time we only go back to st minus n plus 1. Okay, so the difference is that we move forward by 1 period. So it's going to be, so this is a previous window, and then when this new point comes in, this one should move out, right? And then our window starts from here, right? So this point is our st minus n. This point is our t minus n plus 1, all right? And then this is st plus 1. So the point is that this is our previous window, this is our new window. So the only difference is that this one comes in, this one goes out, right? And to look at things from this perspective is good because to calculate the SMA, we no longer need to maintain the history of this full window, right? So imagine every day I need to calculate, I need to know the past 250 days of data, which is a bit painful. But with this one, right? So you're going to see that it's actually quite convenient. So let me do some reshuffling. So this same expression, I want to express it as something that's related to SMA T. Okay, so it has something, it needs to be something relevant to the previous SMA, similar to how we calculate EMA, right? The exponential moving average. So let's look at how to do this, right? So um, so what we can do here is that we want to construct this guy, right? So this guy essentially, so let's write the equation here. It's n and then this st minus n plus dot 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 plus all the way to st. Okay, so that's definition of SMAT, right? But now we have what we need is we actually, so this is new, right? This is new because we sort of added this term ourselves. We need to minus it. So minus st minus n, right? Because we add one, we minus one, right? And then this term is missing here, so we need to add it back, right? So this term is missing because we just, so what we have is essentially, so add something and minus something, right? So if they cancel each other, then they will be the same as the previous equation, which is definition of SMA t plus 1. Okay, so this is simple transformation, but then the re-expression, and we can express this. So now let's treat this guy as a whole, right? This is just SMAT, so SMAT, right? So we're left with this one. So we're left with plus n in the bottom still, but now we have st plus 1 and minus st minus n. Okay, so now this is another expression. So and with this we can now calculate SMA t plus 1. So this one we know because it's just SMA for 50, which is $20, right? And we know n, which is 250. We know the new price point, which is 21, and we know the so what's this? This is the 250 days ago the closing price, which is 80. Right? So this is 200, not 250, right? So this is just 80. So we know everything we need to calculate the SMAT plus 1. So that's essentially the understanding of this definition that makes it's easy to do the calculation on the rolling basis. So for now, we only need to maintain a history of this one, right? So it's going to be changed every period, and as well as the new point and the old point this is going to be added to the window. This is going to be moved out of the window. So this is the changes to the window, and then we have the same window size, right? And now you can calculate this one, and you can find what the signal should be. So if so once you do the calculation, you'll find that this one is above the short term is above the long term. That means we should be in the long position, right? Be in long position. But now we already know that we have 20 and 90.5, so already in a long position, and therefore the position should be unchanged because we're on the position we want to be, right? So there's no need to switch a position. Okay, so that's it for the guided answers. So quick analysis, right? Of course, all the questions we have. Anyone, any questions? So anyone, for those who are in the Zoom session? Justin, Nicholas, Samuel, Schindler. No one, no questions? All right. So if no question, then yeah. So that's pretty much about it. Yeah, so again, any question we can continue to talk in the class. Other than that, yeah, so I'll be seeing you next week. Okay, so thanks for joining.